This is the third segment of our properties video. In the first video, we discussed the basics of property selling, like documents, repatriation rules, and capital gains. And in the second video, we discussed all about TDS and how you can lower it. If you haven't checked out our first two videos, then I would strongly recommend you do the same before jumping onto this one. But if you've decided not to watch the previous videos and want to dive right into this and continue watching this, then welcome aboard. I'll quickly repeat the capital gains tax part for better clarity. Now, the first thing to know is that capital gains can be classified as either short-term or long-term. And what determines which one it is? Well, it's all about how long you have held on to the asset. If you sell a property within 2 years of purchasing it, any profit you make is considered a short-term capital gain and it's taxed at a rate of 30%. On the other hand, if you hold on to the property for more than 2 years before selling it off, the profit will fall into the category of long-term capital gain and it's taxed at a rate of 20%. Now on to the main part of the video where we're going to discuss something that's on everybody's mind when it comes to property transactions: how to save on capital gains tax. While you can't completely avoid paying it, there are some smart strategies that you can use to minimize your tax burden. Let's dive in. First up, we have some valuable exemptions under the Section 54 of the Income Tax Act. These exemptions can help you avoid paying long-term capital gains tax. Let's break them down. Number 1, Section 54. Investment in new residential property from the sale proceeds of sale of old residential property. Now, this deduction is eligible when you buy a residential property from the sale proceeds of another residential property that is owned by you. What you need to keep in mind is, buy the new residential property either within 1 year before or 2 years after the sale, or construct a new residential property within 3 years. You can get an exemption from capital gains tax this way. The exemption you can claim is either the long-term capital gain amount or the cost of the new house, whichever is lower. Let's understand with the help of an example. Say you bought a property worth 1.5 crore rupees. If the long-term capital gain from the sale of an older residential house is 90 lakh rupees, the exemption you can claim is the entire capital gains of 90 lakhs. Another scenario, new residential property price is 75 lakhs and capital gain is the same 90 lakh rupees, then the maximum exemption allowed is 75 lakhs and the balance 15 lakh rupees will be taxable. Keep in mind that this exemption is available only if you are holding 2 residential properties, including the new one. Next, Section 54 EC, Investment in Capital Gain Bonds. Another option is to invest the capital gains in specified bonds issued by entities like the NHAI or REC, Rural Electrification Corporation, within 6 months from the date of sale. This allows you to get an exemption from capital gains tax. The exemption is limited to the investment amount, subject to a maximum of 50 lakh rupees in a given financial year. These bonds typically have a lock-in period of 5 years, and it's worth noting that the interest earned from these bonds is taxable. Another aspect you could keep in mind is the interest offered by these bonds is generally lower. For example, as of 1st April 2023, the interest offered by these bonds was 5.25%. Section 54F, Sale of any other capital asset and buying a residential property. You can claim a reduction under this section if you're selling any long-term asset, including mutual funds, shares, gold ETFs, etc., which were held for long-term, other than a residential property, and using the funds from the sale in buying a residential property. To qualify, you must invest the entire sale proceeds in a new property within 1 year before or 2 years after the sale of the property. If you invest only a portion of the sale proceeds, the exemption will be available proportionately. An important condition here is that you should not own more than 1 residential property other than the one purchased under this exemption on the date of sale of the property. Now, here's a critical point to remember. In all these cases, if the newly purchased property is sold within 3 years, the exemption under the respective section would be withdrawn and capital gains tax would become payable. So there you have it, some smart strategies to save on capital gains tax during property transaction. It's essential to consult with a tax advisor or a professional to navigate these exemptions effectively. Now we're going to look at some additional considerations when it comes to repatriating the sale proceeds from your property in India as an NRI. Now, these are essential points to keep in mind to ensure a smooth process and stay compliant with tax regulations. Double Taxation Avoidance Agreement or DTAA. First up, if the country of your residence has a DTAA with India, you may not have to pay taxes on the income repatriated. However, it's crucial to declare this income in the relevant income tax return of your country to avoid any legal issues. For example, the US has a DTAA with India. If you've paid taxes in India, you must declare this in your IRS, even though you may not have to pay any additional taxes on the sale proceeds or gains. Additionally, any balance of sale proceeds left in your NRO account must be reported in the foreign bank and financial accounts data. It's essential to comply with these reporting requirements to avoid any potential complications down the road. If you have a large property and want to expedite the repatriation process, you can consider using the gift deed option in India. By gifting the property to someone who in turn can use the liberalized remittance scheme or NRS for repatriation, you can streamline the process. However, it's crucial to seek necessary legal and professional advice when pursuing this route. Last but not the least, always retain copies of all the relevant documents. This is important because the Income Tax Department can open cases for NRIs up to 16 years after the transaction. So having comprehensive documentation can help you address any queries or investigations that may arise. So these are some final considerations for repatriating sale proceeds from your property in India. Remember, staying informed and compliant is key to a hassle-free process. Let's summarize what we've learned today. Capital gains tax in India is categorized into two types: short-term and long-term. Short-term capital gains, which arise from the sale of assets held for up to 2 years, are taxed at 30%, while long-term capital gains from assets held for more than 2 years attract a 20% tax. We also discussed the various strategies that can help you save on this tax. Under Section 54, if one buys a new residential property either 1 year before or 2 years after selling their previous property, they can gain an exemption. This exemption will be the lesser amount between the long-term gain and the cost of the new house. Section 54EC provides another avenue for saving by investing in specific capital gain bonds within 6 months of sale. While there's a 5-year lock-in period for these bonds, with the taxable interest, which is currently at 5.25%, exemptions can go up to 15 lakh rupees annually. Section 54F, meant for sale of other capital assets, states that if one invests the entire proceeds into a new property within a span of 1 to 2 years, they can obtain an exemption. However, a partial investment would only offer a proportional exemption. More importantly, the individual should not own more than one residential property apart from the one that they've purchased on the date of sale. For NRIs, it's essential to check if their country has a double taxation avoidance agreement or a DTAA with India and report the repatriated income in their home country's tax return. They must also report the sale proceeds in their non-residential ordinary account or NRO account to adhere to regulations. Gifting large properties can be considered for quicker repatriation as well, but seeking legal advice before doing so is absolutely critical. Lastly, NRIs should retain all pertinent documents for up to 16 years to address any future inquiries. With that, we come to the end of this video. We hope you're clear with the ins and outs of capital gains tax. If you need any further clarifications, make sure to check out trusted sources such as government websites. Till then, keep following Groww NRI for all your NRI-related financial updates. Thank you for watching.